broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to Reducing Taxes with Effective Financial Planning. I'm Vinny Civitello, Communications Manager for the New Jersey Business and Industry Association. With us today from Nisivoccia are Harlene Stevens and Diane DeOliveira. A few housekeeping matters before we get started. Today's webinar is being recorded and will be emailed to you tomorrow along with the PowerPoint for today's presentation, so be on the lookout for those. I'd also like to draw your attention to the Questions tab. Harlene and Diane would be happy to take all of your questions, so don't hesitate to write them in as they come to you, and I can't stress that enough. Write them in as they come to you, or you might forget what you wanted to ask by the time we get to the Q&A. So now let's get things started. Harlene?
Thank you, Vinny. So my name is Harlene Stevens. I'm a CPA. I've been with Nisivoccia for about 13 years, and my focus is on individuals and small businesses. And just to give you an idea of how we're going to run the webinar this morning, I'm going to talk a little bit about the Tax Cuts and Jobs Act of 2017, how it affected some of my clients, what I saw with the 2018 tax filing year. Diane is going to then segue into some retirement savings and just general savings, and how we work together to save money for our clients. And then you'll get me again, and I'm going to talk about the top tax questions that people ask me and some ways to avoid an audit. So just going through, a lot of my clients have asked me about the new tax law, and there was a lot of anxiety before the new tax law came into effect, and clients were saying, how am I going to make out with this? This sounds horrible. I'm not going to be able to deduct my mortgage interest. And in actuality, it wasn't so bad. And most of my clients really did save money with the new tax law. Primarily, this is not on the slide, but the tax rates did go down. So a lot of people just basically saved money because their tax rate went down. But I'm going to talk about just some winners and losers. And if you look at this slide, on the left-hand side, you're talking about the winners of the new tax law. And number one of the big winners is that the standard deduction increased. It doubled in 2017. So for single people, they were getting $6,000 of a standard deduction. Then they were getting $12,000. For married filing joint, they were getting $12,000. Now they're getting $24,000. And those rates went up a little for inflation in 2019 to $12,200 and $24,400. In addition, starting in 2019, there is no penalty if you don't have health insurance. In the past, you might remember from Obamacare, those people that did not have health insurance were penalized. That went away. Big thing that went away for a lot of taxpayers was alternative minimum tax. There's basically, I think for all except one of my clients, the alternative minimum tax went away, and I do tax returns for over 100 clients. So that was a big thing. Again, jumping a little here, starting in 2019, if you are paying alimony, it is no longer deductible, and if you are receiving it, you don't have to claim it as income. Another big change is that people who have 529 plans, so those of you that may have set up a 529, you may have parents or grandparents who set it up. Starting in 2018, 529 plans can now distribute $10,000 per year for elementary and secondary school expenses, which they could not do before. I'm going to hold on to the child tax credit. I'll talk about that in a little bit. So some of the losers, okay, it's not on this slide, but one of the losers is they took away the individual exemptions. Those are no longer here, but the increase in the standard deduction was here. It didn't offset the standard deduction. I think is still better for a lot of people, but those individual exemptions went away altogether. The state and local tax deduction, what is now capped at $10,000. And that's really where you saw most of the people focused on that. I talked about that before with the alternative minimum tax, but that was a very big change. Mortgage interest for those individuals who have mortgage interest, mortgages above $750,000, the additional interest on that is no longer deductible. That was always there, but in the past it was $1 million, so that changed. Another big change was for people who have second mortgages. You may know that as a home equity line of credit. And that interest is no longer deductible unless it was used for home improvements. So some people really got hurt by that because a lot of advice was given by accountants and investment advisors. If you need money for college, if you need money for a new car, take it as a home equity line because you'll be able to deduct that interest, and that went away. Charitable deductions, the deduction for charitable deductions may get lost in the standard deduction. Diane is going to talk about that in depth, about how we can help you actually take your charitable contribution deduction and get the deduction for it. Some of the itemized deductions for payments to attorneys, accountants, investment advisor fees, moving expenses, personal and casualty theft, those went away altogether. But I really saw that that was really only affected high net worth individuals with very high advisor fees. So that is another thing that we did see on the tax returns. But the biggest winner, I think, are families with small children, because starting in 2018, that not only did the child tax credit increase to $2,000 per child under the age of 17, okay, but the income limitation increased for $200,000 for single filers and $400,000 to joint filers. So for example, if you're a married couple, you're earning $350,000 a year, you have 3 children under the age of 17, you can actually get a $6,000 deduction tax credit. That's a dollar for dollar against your tax return. And there's a $1,400 refundable tax credit. So even if you had no tax, you could get an additional $1,400 in a refund. And one of the other things in the new tax law is there's a $500 credit for a non-child dependent, okay? And when we look at that, you want to look at if you have someone living with you where you're providing more than half the support for that child, or that individual, doesn't even have to be a child, you provide more than half their support, you can get a $500 tax credit. So you want to look at people for this credit, like not only your own children, but it can be a brother, sister, grandchild, niece, nephew, grandparent, parents for the non-child. Again, talk to your tax advisor about that. If you have any additional questions, I believe my information will be posted on here and you can contact me directly after the webinar. One of the other things that was a little bit of a change, and I just want to keep that in mind, is this new meals and entertainment deduction. It's not really new, but I wanted to bring it to your attention because it's at the forefront of the IRS, and we think the IRS is going to be looking at this very closely. So if you go out to dinner with a client, your deduction is 50% of the meal. That's no change. It's always been like that. Business has to be discussed. So if you do that, you go out with a client, keep a record of it. Keep your receipt. Write it on your receipt. Write it in your calendar. If you go out or you bring in meals with coworkers, that used to be deductible at 100%. People would call it cafeteria. They would deduct it, 50% deductible. Celebratory meals, an office holiday party, retirement party, 100% deductible. But entertainment costs, like if you go to a Yankee game and you bring a bunch of clients, or you play a round of golf, or you go to a concert or a comedy show, that is not deductible unless you can carve out the meals part of it. Then that would be deductible. I have some clients who have said to me, well, I'm going to get a box at the Yankee game and I'm going to do a seminar before the box and talk about some business stuff. I don't have an answer for that, to be quite honest. I haven't seen that happen. I haven't seen the IRS audit it. I guess, it's always worth a try. But if you do that, I would also make sure you keep very good records of what your costs were for that. The next thing I want to talk about very briefly, even though this was a big thing with the new tax law, is a qualified business income deduction. We call it a pass-through deduction. And basically what that's saying is, if you have a business, if you're a sole proprietor or a partnership or a single LLC or an S Corp, and your business makes money, if your business doesn't make money, forget it. This doesn't have anything to do, you can't get any deduction. But your business makes money, we can look at the net income of the business, compare it to your taxable net income, and you may get a deduction for it. Again, it's something you want to talk to your CPA advisor about. Going into it into a tiny bit more depth is there are some income thresholds. So your income has to be below $160,725 for single filers and $420,400 if you're married filing joint. And if that's the case, you would be able to get the deduction regardless of your business type, regardless if you paid wages, regardless if you have any assets. And when I say regardless of the business type, what's really important is that service businesses, such as consultants, attorneys, CPAs, medical professionals, dental professionals, veterinarians, financial services, those businesses all have limitations. And if your income, taxable income, is over the $421,400, if you're married filing joint, you're screwed. You do not get that deduction. I don't know why that happened. I can tell you that architects and engineers are not considered service businesses. We don't know why. We think they probably had a really good lobbying effort in Congress. But for right now, that's the way it is. And those businesses, if you're above those income levels, will not get a deduction. If you are above those income levels, and let's say you are a manufacturing business, or you're in sales, or you're a real estate agent, you can still get the deduction, but you then have to look at wages and you have to look at assets. Again, and as I said before, this is pretty complicated, and really what you need to do is sit down with your own personal CPA and talk to them about how that can affect you and what are some things you can do to get the best bang for your buck on this deduction. My next slide is a flow chart. It's a little confusing, but it's very good. I'm going to let you go through that on your own. And if you have any questions, you can let me know. And right now, I'm going to segue to Diane. Diane and I work together on helping clients save money for retirement and maybe getting them below those limits that we just talked about. And she's going to give you a lot of good advice on saving money for retirement.
Thank you, Harlene. It's great to be here and to be spending the time to have this conversation, so we appreciate the opportunity. I've been with Nisivoccia Wealth Advisors for the past 5 years, and what's really good about working at Nisivoccia is we're able to combine financial planning advice with the tax advice. So no longer do I have to tell my clients to consult with their CPA about a recommendation I might be making. I can just walk down the hall and see Harlene and get that information. So it's really great to be able to work at the firm. And, you know, Harlene talked a lot about this qualified business income deduction and how there are some businesses that, because they make too much money, aren't going to be able to take advantage of that at all. And that's where helping the business develop a retirement plan, they're able to contribute money into this plan that's going to be able to reduce their taxable income. And oftentimes we're finding that we're able to reduce the taxable income enough so that those businesses that typically would have been over the threshold for the QBI deduction are now able to receive it. So how do we do that? You know, there's a bunch of different types of retirement plans that are out there, and I'm not going to get into all of them. I would say that for 95% of our clients, where they're going is they're opening up a 401k with profit sharing, safe harbor. And what that allows them to do is it allows them to satisfy certain IRS regulations that make sure they're contributing a de minimis amount to their employees, and this allows them to be able to maximize how much that they contribute actually goes back into their pocket. So a lot of times when we run illustrations about what type of retirement plan that we want to set up, we're looking at what is the percentage that a client is going to get compared to the employees. So some of the retirement plans out there that are not 401ks, business owner might be contributing a certain dollar amount and only receiving 60% of its benefit. We're finding with using the 401ks, we're getting business owners to receive 80 to 90% of the contributions that are going in there. So setting up a 401k with a profit sharing is going to allow that business owner to contribute up to the maximum of $56,000 a year. And if that business owner is also over the age of 50, they can do something called a catch-up where the IRS will allow them to contribute an additional $6,000. So for our business owners who are over 50 in 2019, in their defined contribution 401k plan, they're looking at being able to put away $62,000. And that is really helps in reducing that taxable income to help them receive the qualified business income deduction. What we're also seeing with some of our small businesses is that they're not just opening up a 401k. They're also opening up something called the defined benefit plan or a cash balance plan. And the limits on how much dollar contributions can go into those plans are based on, and this is where we call in our actuary friends, and they kind of look at the employee roster and take a look at dates of birth and ages and salaries, and they come up with a figure as to how much can be funded into that plan. And where we see these making the most sense is where there's a greater age disparity of a business owner and his employees. And a great example is a lot of times we'll see this in the medical profession where maybe the doctor has been in practice for several decades, but his support staff might be in their mid-20s or early 30s. So in these cases, we're finding that we're really able to design the plan and design the contribution to really benefit that business owner. And I know, Harlene, you've had several dentists that you've worked with in setting these up, and maybe you can share an example of how that's worked.
Yes, so thanks, Diane. Yes, I think I have one dental practice, and the owner is now, I think he's 60, 61, something like that. His wife is around the same age. She does work in the business also. And we worked with Diane and her group, and we set up for them a defined benefit plan. And he was able to put away around the $225,000 plus the profit sharing, the safe harbor. And yes, his staff does get a nice contribution, which they appreciate. But he gets, when you look at it and you look at his numbers, he's getting a $200,000 tax deduction. And if his tax rate is about 40%, you know, including his state, that is a really nice bang for his buck that he's able to get as a deduction. His income is too high and he's a service business, so he doesn't qualify for the QBI. So this is a really kind of a nice backdoor way to get him to save some additional money. And then I have another client, also a dental client, and his income was close to the threshold of the 421,400. Was a little lower last year because the rates were, those thresholds were lower. And we were able to actually set up a 401k for him where he was able to put away the maximum in the 401k. He also put away some for his staff, and it brought his income under the threshold. And then not only was he able to get this deduction, but he was also able to get the qualified business income deduction. And that is the beauty of being able to work together fast, and get this stuff done for the tax returns to be accurate.
Thank you, Harlene. Yeah, you know, just one last thing I would say is when it's really talking to our business owners and getting to understand what their business is like and how their employees are structured is really where we can offer the advice to make sure we're advising on the best plan to set up for that business. So moving on to another area that we're advising clients on how to get some deductions and save some money in taxes is through something called a health savings account. Now, a health savings account, they're only available to individuals who have a high deductible health plan. High deductible health plan means if you're an individual, the first $1,350 comes out of your pocket. If you're a family, it's the first $2,700. So individuals who have these high deductible health plans are eligible to contribute into the health savings account. And you can see there are limits each year of what those contributions could be. For an individual, the limit is $3,500 for this year, $7,000 for a family. And if one of the family members is 55 or older, they can do a catch-up of an additional $1,000. So they can actually contribute $8,000 into that health savings account. And that contribution gets the first tax preference of getting a tax deduction. So that's income that they're not going to have to pay tax on. Also, you know, what's great, I like to call the health savings account like the Triple Crown winner, because it does get this triple tax preference of the deduction of tax deferral on growth, and then it's tax-free distributions for any money that comes out to pay for medical expenses. So what we see some clients, how we see some clients utilizing the health savings account is they put the $7,000 in for the contribution, but then during the year, they're pulling out the money that they used towards their deductible. They might be pulling money out to pay for co-insurance or co-payments. They'll pull money out to pay for prescriptions. But I think the real way to use these accounts, because if you think about it, someone who has a high deductible health plan, typically they're high income earners. So if you have a high income earner, they should probably have enough cash flow that they're able to not only cover the deductible out of their cash flow, cover the contribution into the HSA, but also cover all the out-of-pocket expenses for the year. And if you think about that, you know, someone in their 30s and 40s that are starting to contribute $7,000 into the health savings account, and they don't touch it. They give it what it's meant to, give it the time to defer, and maybe when they're in their 50s and 60s, they start then taking distributions out for medical expenses. I kind of like to tell clients to think of it as a supplemental retirement account that is specifically earmarked for medical expenses. And what's great about it is when they're taking these distributions out, they can go to cover their Medicare deductibles and co-insurance, but really where you can get a big bang for your buck is those distributions could be used to start paying for long-term care insurance premiums, which are quite expensive. So I like using this plan and having clients really take advantage of the tax-deferred growth of it. Harlene, is there anything you'd like to add with regard to health savings accounts before we move on?
Yeah, the only thing to keep in mind is that if you have Medicare and you're actively on a Medicare plan, you can no longer contribute to a health savings account. So if you decide that you're going to, for whatever reason, stay on your company health plan, and it's still going to be a high deductible plan, even though you're Medicare eligible, you can still contribute. But generally, once you're in Medicare, you cannot contribute. And just be aware and a little wary, if you have an FSA, a flexible spending account, it's for dependent care, it's no problem. But if it's also for medical care, you can't use it for the same thing. So you have to be very careful with the FSA. And generally, you wouldn't have an HSA for medical and an FSA for medical also. And that is, you would see that a lot of times in two-earner families where you both have wages. So that's something that you want to make sure that you look at.
Thanks, Harlene. Moving on, earlier you spoke how that standard deduction was increased for people. So many taxpayers didn't get a tax credit for, or tax deduction for gifts they've made, charitable gifts they've made. So one of the ways we are helping clients who are now taking a standard deduction as opposed to itemizing is saying, okay, where can we at least get some tax benefit for this contribution? So for clients who are of the age 70 and a half or older, they have to make what's called a required minimum distribution every year from their 401ks and IRAs. And the IRS has guidelines in there that if a client makes a distribution directly from their IRA or their 401k to that charity, it will not be taxable, and it will count towards satisfying their required minimum distribution. So for example, if a client has a minimum distribution they need to take of $3,000, but they want to send $500 to the American Cancer Society, they can reach out to the custodian who holds their IRA and fill out the paperwork, and that custodian will send that $500 directly to the charity. And the next year when they get their 1099, they will not have to pay tax on that $500 that went to the charity. Now, I will preface to say that I have seen some custodians who send out those 1099s that aren't as clear that $500 went to a charity and the remainder went to the taxpayer. So I like to advise to, even though you know that went directly to the charity, to be sure to let your tax preparer or your CPA know that, to just annotate that the 1099s are coming in correctly. Other ways, maybe clients not of age 79 and a half yet, or they don't want to make a big deduction all up front to a specific charity. We talk about clumping or lumping their charitable gifts. So, you know, we spoke of the fact that people are taking the standard deduction, so they're not being able to itemize for that charitable gift. But if a client were to say, you know what if I were to clump or lump my charitable gifts for 3 or 4 or 5 years into 1 year, maybe this tax year I can actually get that credit. And Harlene's going to share an example in a minute of how that works. But basically you would lump together, you know, let's say $25,000, and in this example, if you typically were doing $5,000 a year, and you aren't going to want to pay that all out to one charity at once. So this is where a charitable remainder trust or a donor advised fund really comes into play. It allows you to take that big distribution and put it into the fund or the trust, and you get the tax deduction in the year that you put it into the trust or the fund. But what you're able to do is maintain control of how and when those distributions are made. So in an example of $25,000 going into the donor advised fund, you might want to make a $500 distribution here or $1,000 distribution there. It allows you to maintain control of when the funds get distributed, to who they get distributed, and also maintain control of how you want those funds invested while they're in that fund and not being shared with the charities. So maybe Harlene, you can share an example of how this worked for one of your clients.
Sure. So what we do with our clients in conjunction with our financial services group is we do some tax planning with our clients at the end of the year. So I had a client that came in the end of 2018, and we kind of project out where we think they're going to be with their taxes. And we know that they're limited of $10,000 for state and local taxes on their itemized deductions. Their mortgage interest is about $8,000. So we have $18,000 of deductions, and their charity is about $5,000. So we have $18,000 plus $5,000 is $23,000. But even though their itemized deductions are $23,000, they were getting in 2018 $24,000. So really, their itemized deductions could have been $0. They're getting $24,000. So I know these clients, they've been clients for a while, and I know that they usually make charitable contributions of $5,000. So I said to them, why don't you take that $5,000, multiply it by 5, that's $25,000, and put that into a donor advised fund. It'll stay in that fund. Diane talked about those funds before, and they can distribute that money as they want to. So basically what we did was we had their $10,000 of state and local taxes. We had $8,000, we had $8,000, I'm going back, excuse me, we had $10,000 of their state and local taxes. Now we have $25,000 of the charitable contribution, so that is giving them 10 plus 25 is 35,000, plus another 8,000 for their mortgage interest. So now they're getting $43,000 for their itemized deductions, and they're getting the benefit for 5 years of charitable contributions, which they otherwise would have lost. So that's just an example of how that works.
Thanks, Harlene. We're going to kind of segue now into, what are some of the other questions that we're receiving from our clients? And this has to do with taxes as well. Clients are saying, well, where does it make sense for me to make my contribution into either an IRA or 401k? Should I Roth or should I not Roth? That is the question, right? So it really comes down to, where do you want to receive the tax preference? Do you want to receive it on the contribution or on the distribution? And this chart is going to be there for you to refer back to. It just really shows different accounts that are available and where the tax preference is picked up and received. So when thinking about Roth or not to Roth, the advice has always typically been, well, what tax bracket do you think you're going to be in when you retire? If you think you're going to be in a lower tax bracket, it makes sense to put money in pre-tax, because when you take that money out on retirement, you'll be paying a lower tax rate on it. And I would say that advice, while it's true, it's very simplistic, because number one, it's very difficult to forecast what tax bracket you're going to be in when you retire. Number one, the tax codes are always being changed. I mean, these tax laws that Harlene talked about, for corporations, they were made permanent, but for individuals, these are set to phase out in 2025. So, for trying to understand what tax bracket you're in, it's an educated guess at best. What we like to advise clients to think about is think about what type of income sources they're going to receive during retirement. And that will kind of give an indication as to what tax bracket they might be in. So some income people are going to receive is Social Security income. Are they going to receive pension or annuity income? And, you know, how much have they accumulated in their IRAs and 401ks that their required distributions are going to be taxable and can perhaps push them in a higher tax bracket? And what I find very interesting is a statistic I read that a majority of Americans are not going to save enough in their 401ks or their IRAs to actually push them into a higher bracket. So right off the bat, for a majority of Americans, probably the right answer is if you're not a really big saver and maxing out what you're allowed to every year and you just save a little bit here and there, I think a good advice would be go pre-tax, traditional 401k or IRA, because you're never going to have enough at the back end when you're taking those distributions to push you into that higher bracket. But for our clients who are either earning a lot of money or who have been very good savers and have started good saving habits from a young age, there does come a point in time where they accumulate such a large amount in these pre-tax accounts that they really need to think about, how is this going to affect me on the back end? And I'll give you an example of a client I have who worked for AT&T for his whole career and was a very good saver. He's at a point in time now, he's in his mid-70s. Excuse me, his required distributions are close to $200,000. So he would have been someone who, had he had the opportunity, he should have been probably putting some of those deferrals into the Roth bracket, so he wasn't paying those high brackets now. But, you know, ideally we want clients to save their money in different buckets so they have diversification at retirement. So they're getting some money that they're going to have to pay tax on and some money that they've already paid tax on. So while there's really no one answer to Roth or not to Roth, there's a lot involved and a lot that needs to be thought of as to your individual situation and what makes sense for you. And again, if anyone has any questions on this, please feel free to reach out after the webinar. I'd be happy to speak with you about it. Another big question that I am asked a lot of times as a certified financial planner, people want to know, am I on track to retire, or how much actually should I be saving so that when I do want to retire, I'm going to be able to live a lifestyle that I'm accustomed to? And I would say the answer to that really comes down to is, what are you shooting for? Right? A lot of times people in my age we're all just kind of trying to hit that full retirement age so that we know that we're going to get our full Social Security benefit. But what I'm really starting to find are younger millennial clients that are high income earners. They have a totally different mindset. You know, they want to know, when can work be optional? Meaning, when can I, you know, save enough money so that I can continue to live the lifestyle that I want and have the choice whether or not to work. And that all depends on where the retirement income is going to come from. So, you know, is it going to come from your savings and what you've put away in your 401ks? And are you going to have a pension and Social Security? And, you know, Social Security, we could probably have a whole another webinar on strategies for taking Social Security. But what I'll just touch on real quick about Social Security is, to get your full retirement benefit, you need to work until your full retirement age, which for people ranges anywhere from the age of 65 to 67. Benefits can be taken sooner, but if they are taken sooner, you're going to have a reduction in your benefit that you receive, and it's a pretty steep haircut of about 7% per year. So for someone like myself whose full retirement age is 67, if I wanted to take that benefit at 62, I'm going to have a reduction of 35%. And conversely, if I wait to take my benefit after my full retirement age, I get a credit for delaying of 8%. So Social Security income, it's complicated. There's a lot of different strategies to think about of, whether you're married, your life expectancy that play into that figure. But just for rules of thumb for retirement, my favorite rule of thumb is the 50-30-20 rule, and that 50-30-20 rule says you should be spending 50% of your net income on the needs that your family has, 30% on wants, and 20% of savings. And if you start that rule of thumb from a young age and you maintain those habits, I would argue that you're going to have the opportunity to have work be optional at a much younger age than people who aren't living by that rule of thumb. Other rules of thumb that you could see there are, a certain amount of your salary by certain age points, or the 25 multiplier. What the 25 multiplier means is, take a look at where all of your retirement income is going to come from. So let's say there's a couple who each expect to receive $30,000 a year from Social Security. So combined, they're going to receive $60,000, and they need $100,000 for a lifestyle to retire that they would be comfortable with. So they've got a gap there of about $40,000 a year of income that's not guaranteed. So the 25 multiplier would say, well, take that gap, multiply it by 25. That's how much you're going to want to save. So in that example, 40,000 times the 25 multiplier, this couple should probably have saved $1 million before they decide to stop working. So those are some rules of thumb that we use for our clients to just kind of see, am I on track? How am I stacking up against my peers? So I'm going to transition now back to Harlene, who can talk about some questions she's asked from more of a tax perspective.
Thank you very much, Diane. So I've been doing this for a long time. I've been probably, I'm going to say about 25 years now. I've been doing taxes, and I get all kinds of questions from clients. And I thought it would be kind of interesting and helpful if I just kind of talked about what are the most common tax questions. And so one of the big ones is, should I be an S Corp or should I be an LLC? And I would say generally at this point, I advise a lot of my clients to be especially if they're single business people, like a single LLC, it's one person, or it's a small office, I usually advise my clients to go with the LLC. And people would argue and they would say, well, if you tell them to go with an LLC, they have to pay tax on, they have to pay self-employment tax on all their income from the LLC. And there is some truth to that. However, when you look at an S Corp, first of all, the IRS, you still have to take a salary, and you have to take a reasonable salary. And if you don't, the IRS can come back and say you didn't take a reasonable salary, and they can assess that on you, where you'll be responsible anyway for the Social Security tax on that. And then if you're an S Corp, you need to remember that you have to file a separate tax return if you're not a single LLC. So you have to file an S Corp return. You have to pay tax in New Jersey anywhere from a low of $375 up to about $1,500. And I would say most of my clients pay the $1,500 on the S Corp tax. If you're a professional service organization, such as a doctor, dentist, and you have professionals working for you, there's an additional licensing fee that has to be paid. So generally, I would recommend an LLC. There are some exceptions, and again, talk to your own accountant about that. Companies that make a lot of money, and if some accountants will say, well, they should be an S Corp, that'll shield you legally, and there is some truth to that. So again, you do want to talk to your tax professional based on your own particular situation. So another big question, and this is like a huge thing going on now, the IRS is looking at it, the state of New Jersey is looking at it, and people will say to me, can I hire someone as an independent contractor? Can I pay someone as a consultant? And then do I need to issue a 1099? So the answer to that question is, what does the person do for you? Do you tell the person when they have to come to work? Do you regulate their hours? Do they use your equipment? Do you pay them individually? Do you provide them with the materials they need to do their job? Do you provide them with education? Do they work solely for your office? If all those, and I know I'm throwing a lot out here, if all those answers are yes, they're probably not an independent contractor. They're probably an employee, and they probably need to be paid as an employee. And the government looks at that, and New Jersey looks at that. I have a number of clients who have had New Jersey audits, and New Jersey will come in and they'll say, how are you paying people? Now, New Jersey does it for another reason. New Jersey does it because they want their unemployment and disability taxes paid. But if New Jersey comes in and looks at it, you can be liable to pay that difference, and you can be liable for penalties. And the other issue that you have is if you have someone that comes in as an independent contractor, things don't end well, they leave, they walk themselves down to the Division of Unemployment in New Jersey, and they say, I've been working here for 2 years. New Jersey looks up the records. They say, no, you haven't. New Jersey will investigate and say, well, this person says they work there. You said they were an independent contractor. So if someone is an independent contractor, they should make their hours. They come when it's convenient for them. They may have their own LLC. They may work for a number of different offices. And you just want to make sure that you have the proper documentation for that. And if they truly are an independent contractor, then they do need to be issued a 1099 if they're paid $600 or more. Another question we get is, can I claim a deduction for my home office? And the answer is yes, if you truly do have a home office. And not if you're an employee. If you're an employee, you're not going to get the deduction. But if you have your own business and you also have an office out of the house, yes, you can claim a deduction. You want to make sure that you know the square footage of that office. You want to make sure that office is used solely as a home office, and it's not also, you know, used for a TV study. It's not also used for a baby room. It's not also another type of use. So, and you want to look at how you claim that home office, and again, discuss that with your CPA, because if you are claiming a home office and if you take a depreciation expense, then that is going to affect the gain on the sale of your home. Another question, can I show a business loss on my tax return? So again, that is something the IRS, you know, may look at. If you have a business loss year after year after year, that's a flag for an audit. I'll talk about that in a couple minutes. And the IRS can say, you know what, this really is not a business loss. This is really a hobby. But a business loss is deductible. So the one side of the answer to that is yes. The other side is, how long is the loss going on? So that's the answer to that one. Can I hire my children? And I'm going to throw Diane a little bit on the spot now when I talk about this, because we actually didn't talk about this before. But the answer is yes, you can hire your children. And if you do, I would suggest that, you know, you have to give them something to do. They have to have a job assignment. They have to have a job description. I would suggest paying them a certain amount and then taking their money and putting that into a Roth IRA. And Diane, are you comfortable answering this question, how that would be helpful to them?
Absolutely, and I actually work with a few clients that employ this strategy. They have teenagers that they employ, and they pay them a salary, and their salary just happens to be the annual Roth contribution limit every year. So they're getting that salary and also being able to start the Roth IRA clock for those children. And what I mean by that is, with a Roth IRA, you're always able to take out your contributions after 5 years without tax. So getting them started at a young age definitely helps, and we do have many clients that do employ that. But I agree, give them something to do and make them work for it.
Okay, so I have a lot of questions, but I'm just going to do one more. And the clients will say to me, I don't really have to file sales tax returns, do I? And the answer is, if you don't collect sales tax, you don't have to file a sales tax return. But sometimes clients don't really know, and there are some things that they have to pay sales tax on. For example, I work with a lot of dental clients, and if a dentist does whitening on the teeth and sends the patients home with a whitening kit and charges them for that, or charges them for toothbrushes or something, they do have to charge sales tax on that. Sometimes they might not know it, or sometimes they might say, well, I don't do that. And what I suggest to a lot of my business clients is, there's no downside to filing a sales tax return, because if New Jersey at some point comes back and says, hey, you were really liable to pay that sales, to file sales tax returns, there is something called the statute of limitations. They could only go back 4 years. So I would say, when in doubt, file the return. And the last thing that I really want to touch on is advice on how to avoid an audit. And really, we do not have a lot of individual audits. We have some small business audits, which we handle in our office. So if we have a client that is getting audited, we have the auditor come to our office. We are the interaction with the client. We do not have our clients talk to the auditors. We talk to the auditors, and we have the audits done in our office. And we have found that although there could be a finding and there could be taxes due and there could be some penalties, we feel that we do much better having it in our office with limited contact with the clients. But anyway, so how would you get an audit or an IRS notice? The main thing that we see is reporting all your income. If you don't report your income, it's fraud. If you overstate your expenses, they look at it as a mistake. This isn't written anywhere. It's kind of like an underwritten rule that we talk about in our profession. But if you get a 1099, the IRS is going to match that. So, and you can get a 1099 for anything. We think of it as interest, but you could get it, for interest. You get it for dividends. You could get it for income that you made. You get it for a home sale. I had a client this year who got a 1099 for a home sale. He didn't give that to us when we filed his return in 2016. He told us what he sold his home for. It was different. So we got an IRS notice for that, which we responded to. I would ensure, I talked a little bit on the slide before, make sure that all your 1099s are issued. Be average in deducting your expenses. So in other words, if you have a tax return, we do your return, and you show income of $100,000, okay? But your mortgage interest is $50,000. That doesn't make sense. The IRS is going to say, where's this money coming from? Okay, maybe you inherited it. Okay, that's fair. But maybe you're making it on the side. You're collecting cash. The IRS may look at that and they may say that's a red flag. I want to look at your return. Business expenses, you want to look at what some of those business expenses are. Again, if they generate a loss, we talked about that before. If you have income from a foreign bank account, you must report that income. That's very important. There are very high penalties for not reporting that. Sales tax return receipts for the state of New Jersey. New Jersey will look at your sales tax returns, and then they'll look at your business returns, and if those numbers are not the same, you might get taxed on that. And then you don't want to claim a rental loss unless you are a rental real estate professional. Again, all these items are important to discuss with your CPA. If you have any questions, we can talk to you about it. New Jersey has a veterans exemption of $3,000. So if you're a veteran, you want to make sure you took that deduction. And if you are a qualifying widow or widower, you are allowed to file as married filing joint for the 2 years following the death of your spouse. So I think that wraps it up for us.
Thanks, Harlene. I know we're bumping up against the top of the hour right here. So by all means, ask any questions you like. I'm going to keep this open as long as the questions are still going in. If you have to go out to a meeting, lunch, whatever, you're going to get a recording of this after the fact. So don't worry about missing anything, but by all means, keep those questions coming. So we have a couple here already, but I want to give everyone a moment to type in anything they have. If you have a question, type it in the questions tab of your GoToWebinar panel, and don't be shy. You've got two experts here, so make sure to take advantage of them. I can't tell you how many times I read the post-webinar evaluations and see someone disappointed that a relevant topic wasn't covered, that the webinar wasn't broad enough, that it was too in the weeds. This is your opportunity to make the webinar your own and take it in whatever direction you'd like. So with all of that out of the way, let's jump right into the first question that comes from Ashley, who would like to know, who is considered a qualifying child?
Okay, so a qualifying child is someone who's, first of all, it doesn't have to be a child, okay? It can be, if you're qualifying, you have to have lived with the taxpayer for more than half the year, provided more than half the support, and it can be a child, a sister, a brother, a niece, a nephew, a grandchild, and they have to be under the age of 17.
Okay, we have one from Michelle who asks, would the small business retirement plan work well for a condo association with 19 employees and offering a 401k? We currently do not match any portion, but I think I'm hearing that if we did, it could help the association and also offer a nice benefit to the employees who participate.
Yes, absolutely. It would definitely be something to look into. So where you're going to get the most bang for your buck, though, is to make sure that that is a safe harbor plan where you're making sure that employees are getting the de minimis that the IRS determines, and that will allow for greater contributions for the owners.
Linda asks, since there are no longer any exemptions, if you have a dependent over the age of 17 still living at home, should they file their own taxes?
Yes, that would depend on if there's a benefit to them to file their own taxes. So do they have any tax due? So they're not going to, if they're living with someone and they're dependent on someone, and the $500 credit is more advantageous for the person to claim them and get the credit, then I would have them claim them and get the credit. If it's not, then have them file their own tax return. And what we would look for our clients, we generally will look at that two ways. In other words, if there's tax due, definitely file their own return.
Here's one from Scott. If both spouses work from home, can they both take the home office deduction?
That's a great question, and I do allow my clients to take that deduction. I will do it. So if they both have their own offices, that's even better. But if they don't have their own offices, then what I'll usually do is I'll split the square footage of that office. And one of the things about the home office deduction is a couple of years ago, they enacted the simplified deduction for home office. And if you don't want to get into the nitty gritty and be more apt to get looked at by the IRS, we'll take the simplified deduction. And what I probably would do is take 50% of both of them. However, that deduction, you don't get that deduction if the business has a loss. So I would look to see if one of the businesses had profit and one had a loss, then I would put the home office to the business that had the profit.
Okay, we got two more here, but keep them coming. This one is from Cheryl. Can everyone in business get the qualified business income?
And the answer to that is no, because it depends on income limitations, which I talked about earlier in the presentation. So everyone that's in business that has a profit has the ability to get the deduction, but it is subject to income limitations and wage earnings and fixed asset values. So you have to look at it each case individually based on the type of the business.
Okay, Shelley asks, what is the best retirement plan for my single LLC?
For single LLC with no employees, it would be opening up what's called a solo 401k, and there you'll be able to, based on your age, contribute for 2019 anywhere up to, you can defer $19,000 for your salary for the year. You're allowed a $6,000 catch up, and you're able to also profit share into that up to a maximum of $56,000. And again, if you're over the age of 50, you can put an additional $6,000. So for people, if you have your own business and you're 50 or older, you can put away $62,000 in solo 401k. And actually, as a sole proprietor as well, you can even open your own defined benefit plan and take advantage of both.
Cool. Well, that's all the questions we have, so it's a good time as any to bring things to a close. Don't forget, all of you will be receiving a recording of today's webinar and the PowerPoint slides via email. Lastly, when you close out of the webinar, a survey will come up on your screen that we hope you'll fill out so we can understand how to best provide you important information in a webinar format. Our next webinar, NJBIA Resources for Small Businesses and Startups, will take place on September 25th. So by all means, feel free to register for that one at our website, njbia.org. So until next time, for Harlene Stevens and Diane DeOliveira, this is Vinny Civitello thanking you for being with us this morning and wishing you a great day.